Hey traders, Raghee here. Welcome to Charts and Coffee for Wednesday, CPI Wednesday. Happy August 11, everybody. Hope everyone's doing well. I've been watching the indices this morning, looking at the reaction to, what has to be kind of a confirmation of what the Fed's been saying. Look, I'm not talking about reality because the person who dictates the reality is, the people who dictate reality are the Fed. Their reality is what shapes monetary policy messaging and ultimately monetary policy. So I'm not trying to front run the Fed. I'm not trying to get too cute. I am going to observe the data points that the people who have their hands on the lever and the dials are watching, and that is inflation and GDP. Mostly inflation. Now remember that the inflation number that is the Federal Reserve sort of pet number is the PCE. Okay, keep that in mind. CPI is more, well, it's a more realistic look at inflation, but who cares about reality, right? I mean, let's be real for a moment. The idea that we're somehow pursuing reality and that the markets are wrong or that the Fed is wrong, that's going to get us into a lot more trouble. So let's not try to get cute and front run things. Let's not get what I call the big short syndrome. Let's not go there. It's going to just cause a lot of pain. Trade what you see, and we'll stick with that. With that being said, I am looking for more strength on the open, but again, in specific places. What indices have been strong up till now? The indices that have been strong up till now have been S&P and NASDAQ. And I think Dow is trying to organize into a double green. We can see we're getting very fresh indication of the moving averages being stacked in the way, 8 over 13, 13 over 21, 21 over 34, 34 being the one that is the trend analysis, 8, 13, 21, sentiment and momentum. We divide those two along the very bottom of my chart here with the JT multi. Things are looking good in the big three, absolutely in the big three. And then I just presume that, we're going to see, small caps just catch up because look, it's all about how the Fed perceives this, this inflation picture, transitory, and it's looking like they get to have their way right now. So with that being said, let's jump into the questions. Let's go ahead and tackle the first one here. And the question is, good morning. Good morning. Can I explain why one instance of inflation causes fear in the market and the next report causes confidence in the market? Mud Dauber, I think some people are going to get upset when I say this, but I've been doing this for 30 plus years, and this is the paradigm that works for me. This is a game we are playing. It is a game. It's a game of momentum. It's a game of perception. And, we talk about a hot hand or the team that's gained momentum. If you look at this as a game, there's winners and losers, there's rules, there's points. You'll realize that these are just momentum shifts perceived by, if a report indicates the inflation is very, very hot. Remember that the Federal Reserve, who's been trying to communicate to the market, again, forget what's real, right? We already talked about that. So they're trying to communicate to the market this is transitory inflation, that the economy is not overheating that much. When the numbers justify their story, their narrative, then we know the Fed's in charge. And the Fed is continuing to spend $120 billion per month. They're continuing to increase the balance sheet. They're continuing with the asset purchases. So it's tough to argue with them. They've got a leg to stand on. When the CPI is in line, I won't call it a miss, but it's certainly not indicating that the inflation number is just roaring and that the Federal Reserve is wrong. So the stock market moves higher. And Wednesday, I had a lot of folks. It's funny. I have a newsletter called The Countdown Trader, and some of you might know that. Maybe you've checked it out. And I think a lot of folks think about the DeMark counts. Some of you might be familiar with the DeMarks. 13s are very popular, as are 9s. And there was a big deal about the 13 maybe a day or so ago. And 13s have been notoriously wrong this year. Nothing against the mark. It's not a big part of what I do. I do follow and understand the counts, but it's not a big part of what I do. I think the countdown trader sort of invites that question. There is a 13 hanging over the market. And I talked about this to the sector secrets folks and the futures folks, and I think the options folks yesterday too, that this inflation number is a catalyst. And catalysts for psychology are going to dictate whether traders feel happy pushing the buy button or whether they feel happy pushing the sell button. This morning, as long as the Federal Reserve is not proven to be way off on their inflation messaging, equities are going to rally. It's just that simple. So you're absolutely right. Why is that? It's the way in which we measure how right or wrong the messaging of the Federal Reserve is. And that's the way that I look at it. And that's the way that works, for me. What is the volume profile indicator that I use? Donald, the one that's built into the platform. There's a lot of great ones, and it's built into the platform. It's volume profile. You'll see a bunch of free ones there too. It just depends on how you want to do it. If you want to do the variable range or visible range, or whether you want to dictate the number of lookbacks and overlay, say, 3 or 4 of them. There's a couple ways to set it up. I'm using the visible or variable range. Next up is looking at double green, SMH. Tough to want to bet against tech. I can't say SMH or CLOU are my favorite, Debbie. I do like CIBR, XLK, XLC, even XLY a little bit better. But let's talk about Qualcomm. Sure. Within the SMH, we have Qualcomm, double green, pullback. Can we look at an entry here? Well, number one, I need the market to be inside the wave, preferably, or no higher than the 21 exponential. And this Darvis and 21 exponential are coming together really nice around 44.60. So you can look at 43.04, 43, step out in front of the handle. That's great. But I think you might have an aggro opportunity at 44.60 if we can get down there. Okay. And again, I love that you're looking at sector stock, top-down analysis, index sector stock, find the relative performing index, find the relative performing sectors, and then find those relative performing stocks within them. So love it. That's what I'd keep an eye on maybe for an aggro fill. All right. Okay, next up is, hey there, Dave. Does the infrastructure bill have me looking at any options plays? So I'm not going to play infrastructure because remember, we've all known this is coming at some point in some shape or form. We didn't know what the ultimate figure was going to be for the bill, for the spending, but we knew that it was coming. And if we know something's coming, then it's already been discounted, priced in. People have made their bets, so to speak. Yes. So the time for those plays was long before the passage of the bill. So the answer is no. And that window for me is closed. So, I'd be looking at that infrastructure bill. Look, I've been playing infrastructure since before the election. And those of you in the Sector Secrets room know that we said, hey, what are the different sectors? What are the different niche markets that would benefit from either side winning? Not picking a side, but what particular corners of the market benefit regardless of who's in the White House. And so the idea was, well, infrastructure wins either way. And then, fast forward to August of this year, it's not been an easy play. Those are tricky things. I really haven't been focused on that because funny enough, it hasn't been a great relative outperformer. So great question, but that window for me is closed. TTEC, sure. Okay, is that what it is? TTEC? I'm not getting that symbol, so yeah, maybe is it a typo? Let me know. I'm not getting that symbol pulling up, my friend. Unless that means something else. I'm terrible about all these acronyms. So I don't know if I'm getting that wrong. Let me know. ISRG in the meanwhile. Big pullback, double green. What's not to like about it? We're sitting at 995.40 4 or 5 pre-market, that puts us at the 13 exponential moving average. Clearly enough propulsion dots to justify an entry at that level. I love my moving averages. That would be just an aggro pullback. Very interesting. Now, the thing that I don't know, and I'm going to check to see if I have that data, because I don't know that I do. I do. Okay. So you see the size of the candle? That gets my attention. Just from a visual scan, it just seems to be larger than most. So I'm just going to double check. Okay, 26 and a half, 26 points. Okay. What does that mean? Well, I am quite curious whether this range is beyond the typical price movement. And indeed it is. So anything beyond 26, 27 points in ISRG requires that I wait for an inside day or minor low. So while this is a pullback to the 13 EMA, I will wait. And this is the same process that we talk about regarding gaps, regarding any kind of extreme move. One, you have to have a methodology, a measuring stick to be able to recognize what an extreme move is. Not it's a big candle, but it's a big candle in relation to what? Relative performance tells me anything above 26 and change is a daily price movement range sort of anomaly, if you will, or beyond the 68% probability. So because we're doing something that's unusual, it makes sense to give the market a second, give it a moment to sort of collect itself. And in the case of ISRG, let's wait for an inside candle or a minor low. That's what I would do. Now, could you buy into that? Sure, but just position size and treat it like it's aggro. Position size and treat it as if hey, this is a little outside its normal personality. So great question. All right, Craig says, coffee in hand. Same here, my friend. Is there an infrastructure ETF to track? There's not a lot of great ones, my friend. You'd think that there would be a lot. There actually aren't. Irritatingly, most of them are global infrastructure ETFs, not a lot of domestic ones. So you end up going individual to stocks that are related to that narrative. Do I have a target on GLD? I don't have an entry on GLD yet, but if I have a target, if we're talking GLD, and thanks for the question, Kip, I would say, GC, the gold futures have triggered the inside day entry by breaking 1740. Now, I'd love to see this market back to 1780. That's the point of control. It's a volume-derived level. And, for those of you that have been following my work, volume is one of the 4 factors I always factor in to trades. So 1780 is a really good level to watch. And we have triggered that inside day. Now, for those of you trading GLD, this is not actionable until 9:30. So keep that in mind in terms of what it is that we need to see. We're seeing it now. Is there a confirmed potential buying opportunity? Yes, but none of my levels for entry or exit stops or targets are using GLD. They're all going to be based in the GC futures. So if you're on TOS, just throw in a /GC. If you're on TradingView, GC, the number 1 exclamation point. And if you're on TradeStation, do the @GC. So whatever platform you're on, pull up the futures contract, use that contract for your levels, and then once you have levels that are actionable, the triggers, then execute the idea in options on GC, or perhaps the micro gold, or perhaps GLD, or options on GC. So this is the choose your own adventure part of the trade, but everything is built on the GC. So thanks for the question. Here, hey there, Tony. What's the difference between Darvis box, ATR, and EM? I don't know what EM is. EMAs, perhaps? Well, the difference is how they're calculated. That's always the answer to any question about different tools. It's how they're calculated, what they're using, and how they're using it. Average true range. Now look, when it comes to Darvis is a pattern. So it's kind of like asking what the difference between a triangle chart pattern and an ATR is, right? So it's the difference between a formation, a pattern, and average true range. Average true range is not something that I use habitually. ATR, I actually use PMRs. So versus the average true range, which is looking at a set number of sessions and then giving you the calculation. Usually average true ranges are set to 14, maybe 7, 14, 21 periods. The PMR is set to 6 months. So really, if you think about what a historical average true range would be that separates the hours of the day and the days of the week, you have PMR. So PMR is, my opinion, vastly superior to ATR. They're driving along, they're driving parallel roads down, but they're not really the same thing, but they're looking at trying to decode the market in a similar way. Exponential moving averages are right back to price. So you look at a set number of periods, we're averaging, and then we're giving specific emphasis to more recent price action within the set number of periods, as opposed to the older. So if you're looking at, say, a 34 EMA or a 55 EMA, both popular EMAs for me, say the more recent data is just more heavily weighted than the earlier periods within that set, or earlier days within that set. So just completely different calculations, right? I mean, we can all talk about indicators, like we can talk about cookies, but oatmeal raisin is just fundamentally a different cookie than a chocolate chip. And that's really it. That's really the difference. It's what is it looking at and how is it calculated? Thanks for the question, Tony. Dimitri, good morning. Which subscription on Seasonax? No, you don't need anything fancy. I think I'm on the lowest level. It's like $14 a month. I don't remember what's hang on. I'll tell you right now. Yeah, I don't even remember. It depends on what I'm doing and what I need. But over the years, I think I'm on the $14 a month one is the one that I'm using. There's a free version too. It's not as good as the paid versions, but I think I'm on a 14, or it's very inexpensive. Dimitri, yeah, that's the one I believe I'm using. I've used the different levels. I think I've used all the different subscription levels, and I settled on that one because that's all I really needed. Because look, seasonals are just suggestions, right? They're not setups. And I think a lot of people are realizing, especially so far with August, please, please, please don't blindly follow seasonals. It's a tempting siren song. But if you see me set up Seasonax and the way that I use it, there is just fundamentally a very, very different. When you look at debug, detrended, and different lookbacks within seasonals, you get very different results. And just like any other analysis, you've really got to understand what you're studying. We know that a 200 period exponential moving average is different than a 20. Why? It's looking at a different amount of data. Seasonals are the same way. And even though I'm a fan of seasonals, I've just seen consistently over the years such awful seasonal analysis where it just seems to be one size fits all. And this is what happens on a Tuesday. No. Really, really. It reminds me of a conversation that I had with Larry Williams over lunch one time. Now, Larry Williams has intraday seasonals. He was the one to sort of really be saying, wait a minute, there are tendencies even intraday on seasonals. And that conversation, I know for me, was probably a sea change in the way that I look at seasonals. And, if the previous week had certain behavior, Monday through Friday, the next week does have a different kind of behavior. So you really got to think about the look back. And I know I'm going down a rabbit hole now, but, luckily I've run into people who have really spent a large part of their career deep diving seasonals, not like as a hobby because I bought a book on Amazon one day, but because I really dove into the data. So I'm standing on top. I'm standing atop the giants of that. So I'm sharing with you what I've learned from them, and really grateful for that because there's so many ways to look at it. So many ways. Love the countdown trade. I appreciate that, Melissa. Thank you. Thank you very much. My partner here in the office, Trish, she's the one that gets the credit for that because she's the one that's determining the topics, studying comments, looking at what the markets are doing, and then the way that my work kind of relates to it. So I cannot take credit really at all. She really does guide the direction of that newsletter. So I will definitely pass that on. Thank you, Melissa. All right, next up. Oh, am I out of time? Oh my gosh, it's 9:20. All right, so with a big gap over HPMR, what do? Pause. It's a great place to end the show. If the market, regardless of the tool that you're using, if the market moves in a way that goes beyond the scope of what your tool analyzes, hit the pause button, because now we've gone outside of the probabilities of what that tool is communicating. Feel comfortable hitting the pause button. I mean, that's something I know has saved my behind many, many times in my trading career. All right, with that being said, I've got to go jump into the Sector Secrets room right now. We have a weekly Q&A that we do every Wednesday, starting at 9:20. I'm jumping over there right now. Thanks as always for being a part of the Charts and Coffee crew. See you all tomorrow, same time, same station. In the meanwhile, be good to each other. I'll talk with you soon.